Well, thank you everybody for joining the BlueStem Wealth Partners Financial Markets Update. Today's commentary is being recorded on April 14th, 2026. And so my name is Scott Marquardt. I'm here with Chris Shuba. I'm a wealth advisor, private wealth advisor, managing partner of BlueStem Wealth Partners. Chris Shuba, of course, is the CEO of Helios Quantitative. And we've done this, this
Many
little
times.
quarterly update many times. Quite frankly, it's one of my favorite times of the quarter, because like we just get to chat about things that are on people, things that are on people's minds, and it's kind of unscripted. We kind of go whatever direction the conversation takes us. So hopefully this is valuable for the listeners, and we'll kind of get right into it. We've got a pretty good, we've got a lot of things that we could talk about. So let's just maybe dive right in.
Do it.
Perfect. All right. So, a lot of these questions are questions that we poll, certain people in our organization. We've got an investment group, advisors, of course. A lot of people talk to, different people in our organization, talk to clients. And we just have a lot of things that, kind of ammunition that we could bring to this call. And so that's kind of the goal, right? Is things that we're hearing about, we want to bring to this call, kind of address. And, right now there's all kinds of things, right? There's the war in Iran, there's market volatility. It just seems like more and more these days I hear about increasing prices and how expensive things are. So we have inflation. And all of these things, the national debt, right? I mean, that's approaching if it wasn't a ridiculous number already, it's really getting there, right, at that $40 trillion. So we have all of these things, and yet, generally an increasing market, right? And so when you have a softening economy with inflation and all of the other things that we had talked about, it just seems counterintuitive, right, for the market to continue to kind of keep creeping up. Now we saw a pretty decent, I don't even want to say pretty decent. We saw a little bit of a decline here in the first part of this year, 5-6%, something like that. But in general, it's the market continues to climb, right? And so I think we just want to, maybe in general, if you just kind of want to open it up, Chris, about how are all these things tying together? Like, how can we make sense of that? And does it make sense, from a quantitative analysis, mathematical probability calculation standpoint, right?
Yeah. Well, the easiest thing for me is I kind of section things off into unique decision-making groups, right? So the stock market is one, right? The stock market is very, very, very focused on one thing and one thing only, and that is the forward expectation of corporate earnings. That's it, right? And so you can have a soft set of economic data like we have right now, but yet companies produce pretty good earnings, or at least the companies that matter now because of how top heavy the S&P is. And you can have a market that continues to move upward, especially sectors that continue to move upward despite soft economic data, right? Now, eventually, the economic data becomes bad enough where even really skilled corporate managers can't keep pumping out really good corporate earnings. But for a long time, those two things can disconnect with each other, right? Same thing goes with the war in Iran, right? Where you have a knee-jerk reaction, you have a lot of follow-on trades, you have volatility around uncertainty. And as soon as that uncertainty starts to go away, then the market kind of forgets about things. Right now we're recording this, and the market's been up the last couple of days, despite the first round of Iran's talks, of the peace talks, so to speak, failed. And we all thought coming out of the weekend that because of the blockade of Iranian ports, that we were going to see volatility yesterday and today, but it's been completely the opposite. And the reason for that is the market is simply saying, hey, both sides are talking. It's very early in the conflict for anybody to even be talking, relatively speaking. So the odds are this is going to be over fairly soon, right? Kind of a thought process. But it could have just as easily been that we showed up yesterday and markets are down 2%, right? So we're in a very uncertain period of time, and different types of analytics are going to expose how concerned we should be. Some are going to say don't be concerned at all. Some are going to say, protect yourself, right? And that's why we want lots of algorithms doing different things so that at a portfolio level you get the net effect, right? And that's the main goal through getting through, from our perspective, periods of time. But if you try to lump it all together into one thing that makes sense, it never works. But if I can just sit back and say, how does this affect corporate earnings or the potential for corporate earnings? And if it's not that bad, I'm not really worried about the market, at least in the short term, as an example. So
Yeah. Well, I do think that's, it's really important for everybody to understand it. And we try to, we talk to clients about this a lot in terms of like, well, why do you manage the money the way that you do? And to your point, Chris, you look through all periods of time and you will find periods of volatility, periods of uncertainty, periods of political unrest, or whatever geopolitical conflict, and you can point to those periods of time and say, this algorithm performed better during that period of time than this period of time, even though on paper they almost look kind of the same, right?
Mm-hmm. Yep.
And I think that's an interesting and an important part of that is because like you said, they don't all move in lockstep, and the story doesn't always end the same, but it's what do they say? It's not the same story, but it does rhyme or something like that. Like
Yep.
you can pick up some of those trends, but yeah, that's exactly right. I think things portfolios like our managed risk, right? For example, I'm sure, and I shouldn't say I'm sure, I know during periods of times like this, it gets a little spooky, right? Because that's one of those that says, that volatility, in our world, in this calculation means that we need to back off a little bit, right? But not necessarily in portfolio B over here.
Yeah. Well, and it's interesting because right now we're in an interesting data environment where there's a lot of disagreement, right? So when you think about, a bunch of algorithms are out there, think of it like a committee of experts, right? And each one of them has an expertise that pertains to something very, very specific. So there's one historical expert, right? There's one forecasting expert. There's one economic expert. And they can all look at the same set of data through their unique lens and come up with a different answer. When you look at trend-based analytics or backward-looking analytics, we're still in a risk-on environment because realistically, we've made so much money over the last 3 years, 65%, give or take. It's okay if you give back 10. It's okay if you give back 15. That's normal given how much you made. So trend analytics are still risk-on. You go over to volatility analytics, which are about the right now looking forward and saying, this is not the time you want to be greedy. You want to protect during these periods of uncertainty. And so in a portfolio, one's going to be right and one's going to be wrong. So you're going to have one account that outperforms and one account that underperforms, but none of that actually matters. It's the net, right? Mm-hmm. You're locating risk management into certain accounts that are going to net a certain effect. And the net result is that the more experts in your panel that become cautious, the more overall cautious your portfolio gets. The more they become excited, the more excited your portfolio gets. But that's how you control incremental risk management is, analysis by analysis. You don't just get one analysis and do one thing. That's how you end up getting whipsawed too badly that a little bit of whipsaw is normal. You're going to get whipsawed, but you just don't want massive whipsaw because that's hard to be recovered from. Or taking too much risk off the table when you really didn't need to, right? And that's the other end of it. So, yeah, I mean, we could talk all day long about those differences, but I think, certainly periods like this Iran war where you have a acute external influence coming into the markets and the economy, obviously different calculations are going to react differently because it's not innate, right? An innate economic issue, an innate credit issue, an innate interest rate issue, those come through data sets in many ways. but an externality that comes in from politics, as an example, is just going to land hard at whatever it's directly affecting, and then the ripple effect goes out from there. Very, very different ways that the math works, different experiences, but net on net, given everything that's involved right now, all the different algorithms, now is not the time to be greedy, right?
Yeah.
Now is the time to kind of just hunker down a little bit, be neutral, maybe even be a little bit underweight. Doesn't matter if you make excess returns, who cares if you make an extra 1%? What you really don't want to do is put yourself in a position where the next externality lands on you and then it's years to recover. That's risk management versus returns management. Two very different things.
Yeah. And again, a lot of the things that that we work with you on and you do the heavy lifting on this is, really identifying the long-term position that you need to be in, right? I mean, we talk about this kind of stuff in these short-term externalities, and you're not trying to time the market. You're not trying to get in and 5 days later get back, get out and that kind of thing, because I think the last one is a really good example with the Iran war. There was a few, more than a few, really tough days, right, for people, watching their account values and things like that. And if you make a knee-jerk reaction on that, and if you're not sure what I'm referring to here, but just look at the chart of an S&P 500 or a global index like the ACWI or something like that, and you'll see how sharply that bounces back when, like you said, the market kind of shrugs it off and say, this will probably be over, relatively short, so, again, it's that process, and that whole idea of underperforming, outperforming, it's really compounding over time is what we're really getting after, right? And to your point, it's harder to compound when, you have to come back from such a deep hole and you don't have those risk management positions in place. So,
yeah, these are the types of environments, historically speaking, with the economic data the way it looks and the externalities that are in place. These are the kinds of environments where 80% of the time, the volatility is going to pass us by.
Yeah.
20% of the time, you get hit really hard. Now, underperforming a little bit in the 80%, easy to recover from, because when the markets turn up and there's less risk, you can step on the gas and make up that ground. But if you get hit really hard in that 20%, and some people never recover from that in their lifetime, right? Because lives are finite. So these are the periods of time where, risk management is a thankless job, right? Because 80% of the time you're not going to get rewarded for it in your seat, right? Or in my seat. But it's the hard work that we do because the 20% is so bad. You just have to deal with that, just talking through it, and that piece of it. So setting expectations in advance is always the hopeful mitigator to that. And I think 95% of investors get it. Obviously, you have to deal with the 5% that want to win all the time. And that's a hard thing to do. Yeah.
Yeah.
Yep. Mm-hmm.
Yeah, I agree, and we have a lot of those conversations, and they're fruitful for the most part, right? Because it gets people to look out, further than just what's right in front of them. So, no, that's really good. Okay, so let's switch gears just a little bit, and again, I think now focus, kind of on another sleeve here, another topic. I think it still generally gets lumped in with all of the, all the bad things that are going on in this world, and what's the cause of, the effect of this. But it's one that I think about a lot, and it is the national debt, right?
Mm-hmm.
And it's not even so much the number, even though 40 trillion is just a number that most people, it just rolls off their tongue and they don't really think about what that number means. And it's just it's an unbelievably big number. Mm-hmm. We are also an unbelievably big economy too, right? Mm-hmm. I mean, that's the other part of that. But what I think concerns me and others out there is there just seems to be no end, right? Like when does the credit card get turned off? Mm-hmm. and what does that look like? And I know this has deep implications to politics and and people wanting to get elected and policy and all that kind of stuff. But give us just a a nugget on what this $40 trillion number means to, the markets, the economy, wherever you want to go with that.
Yeah, yeah. I mean, this is a very, very common question I get, and so over the years I've kind of honed in on a fairly short response, and that is that the credit card turns off, to your point, when our annualized growth rate is expected to be zero. That's it. As long as you have growth in the economy, you can keep kicking that can down the road, right? Because you keep paying your bills and you keep paying your rate, right? Now, that's fixed rate stuff. So a lot of times when we have higher interest rates, you're taking on more monthly bills, right? Your debt gets higher, your payment gets higher. And then we go through periods of very low interest rates where all that gets kind of refinanced, right? The government buys back all the bonds they don't want anymore. They issue new ones. It's a shell game in that regard, right? So they effectively manage it, right? But overall, what matters is growth. If you keep growing, it's like a person, right? As long as you keep getting paid more at your job, you can buy a bigger house and take just the way it goes, right? If you keep making more money, you can borrow more money, right? It's a fraction of it's a cost of growth. And eventually what will happen is that the cost to our economy, that debt payment, will get so large that we can't grow anymore, that our growth rate is now zero or becomes negative. And that's when the bill comes due, right? And until that point in time, there is literally zero political willpower that's willing to tackle the problem, because the center point of that problem are things like earned benefits, Medicare, Medicaid, Social Security, the things that are these massive underpinnings of our society that voters, like like a lot of people on this call, are not going to vote to get rid of their Social Security or cut it in half, right? Or it's just not going to happen. So it's usually, funny enough, the folks that complain the loudest about it are exactly the people that are going to not vote for what it takes to fix it, right? Because there's literally, between earned benefits and military spending, like, everything else is a drop in the bucket. Those two things are massively the issue. So fixing it is nothing that any politician, if a politician stood up right now and said, my main goal is fixing the federal deficit, and this is the roadmap, they would not get elected. Period.
Right. Yeah, I would also add, and correct me if I'm wrong in here, but you talk about the benefits and things like that. I would also add, the amount of interest that's being paid on our debt is getting to be a very concerning amount as well, right? I mean, that's a big part of our budget. I mean, we get your tax receipts and things like that. The income that comes into the United States Treasury, how much of that money is going out just in interest payments on the debt is quite alarming too. So I would argue that, yes, you have these big benefits and the Social Securities, the Medicares, and things like that. The entitlements, that's the word I was looking for. You have these entitlements, but then
I got yelled at for that. You're supposed to call them earned benefits.
Earned
I
benefits,
called them entitlements, and I got yelled at.
That's fair. Fair enough. Everybody's paying into it. I get that, right? So,
but I used entitlements for years. And
yeah, well, that's what they've always been called.
Yeah, I know.
But yeah, between those military and and the interest, there's just not a lot left over, and you just wonder how far that how long that growth can last. So. We could talk about just this topic for hours.
I'll tie this around to something that's important, right? So our growth rate is essentially directly related to productivity, right? And so productivity is a curve, right? It's the number of people you have and the amount of capital you invest in them to train them so they become more productive. Now, obviously, when you're a baby, you're at zero productivity, and then you leap up really quickly, and then you begin to plateau, right? There's only so much investment you can make in someone to make them more productive, right? And so societies that have more people and can invest in them have an advantage. The US, as an example, is completely dependent on two things for productivity. First is immigration. We don't make enough babies. So we need population to obviously increase productivity, to be buyers, to be small business owners, to create growth, right? The other thing, and most importantly, is technology. So that curve is what it is and never changes until technology comes along and shifts the entire curve. Example of this is that if I have a guy with a rake can do the job of one guy with a rake, but all of a sudden I give him a backhoe and he can do the job of 100 men, right? And that's the exact same thing, back in the 90s when the personal computer or broad-based computing came into play, right? Now one accountant could do the job of 100 accountants. And of course, all the fears came out about, robots are going to replace everyone, right? But that's not what happened. What happened is we just became way more productive, right? And that's what AI is. AI is the next leap in the productivity curve that we have to have because we don't make enough babies and we don't get enough immigration. If we want growth, if we have to pay that bill every month, we need to be more productive. Now that accountant that was one accountant that became 100 accountants, now that accountant's going to become 1,000 accountants, right? And so it's not getting rid of the need for accountants. It's simply making them way better at their job that everyone benefits from. There's never been an increase in technology that did not benefit humanity substantially, right? And so everyone's running around, with all these fears about AI taking over the world. And I watch movies too, right? I can think of a lot of, crazy scenarios, but the thing I tell my wife all the time is if you hear hoofbeats, think horses, not zebras, right? It's not the low probability thing, it's the high probability thing. And the high probability thing is humans are going to use technology, become way more productive. And that's it, right? So AI, for those of you that are concerned about the debt, you should be loving this because it's productivity in a beautiful form, right?
Yeah.
So
yeah. And I would encourage anybody who's listening to this, if you really have a passion around a certain topic like this, and you really want to hear about that, send that our way, email us, talk to your advisor. We will for sure address it because again, I think we could spend, a lot more time on something like this just to kind of, poke holes in that. And I agree with you, Chris, like, the one thing that's just not on a lot of people's minds is the possibility that the technology piece of this could potentially, just be a boon for the economy. Maybe it won't,
Well,
maybe it will, maybe it won't, but it could be, right?
yeah.
And to your point, probability wise, at least up until this point, we've not seen a technology advance to your point that has put us in reverse, right?
Yeah.
For lack of a better term. So
Well, and the other thing that's really important about a lot of these mechanisms, and I'm almost always a glass half full kind of person, right? But I was talking to somebody about this about a month and a half ago, and he works for a company that is working with a couple of government agencies to build technology for people who are disabled to rejoin the workforce. So think about what that means. You have folks that are in a really bad spot, disabled in one way or the other, on Social Security, on Medicare, on Medicaid, converting that to someone who's productive, happier now, right? Nobody wants to be disabled. Nobody wants to be sitting in their house all day long, right? I mean, I know there's the exceptions, but nobody wants that, right? Now, think about, technology has never reversed things in that way before, but AI has that ability to do that. So there's so many things that we're going to talk about in 10 years that don't even exist right now that are massive parts of our lives in the same way that 20 years ago, Amazon didn't exist. Google did. You know what I mean? Like the things that are core and central to our everyday right now weren't even a blip when computers came around at the turn of the century. And now they're the largest companies in the world. We will have this exact same thing 10 years from now.
yeah,
We just don't know yet.
Exactly right. It's going to be as we say, a fun and an interesting, next
What else do
decade
we
or
have to do?
two.
Might as
Right?
well have something interesting to do.
That's right.
Otherwise, it's the
That's
same
right.
old thing all the time, right?
Well, unfortunately, we are probably past time. I know we try to keep this to about 20 minutes, and I think we're a little bit over. But Chris, I just want to thank you for, again, taking time to do this every quarter. We really appreciate it. We love the relationship that we have, with you and your team and everybody. And it's really great to just have you come on here and have have all of our clients, have access to you. And so I thank you again.
Likewise, it's a
Perfect.
mutual appreciation club here. Yeah, and if we need to do a special one of these on a topic, go deep into one, let's do it.
Well, there you have it, folks. Right? There's the open invitation. If anybody's got a real passion around any sort of topic that they really want to dive deep into, I guess we can figure out a way to make that work.
And we should have a beer during it. Because then it's not enough to taint the conversation, but it's just enough to take the little bit of should I really say that or not? We'll take it away with a beer, but it'll still be good factual information.
Yeah, very good. Well, we'll have to talk a little bit more about that one, but
that's a no. That's a no. I see it coming.
All right. Well, I'll get this wrapped up. Thanks for everybody for listening. Again, if you want to reach out to anyone on our team, your advisor, again, 612-464-0372. Again, Chris, thank you very much. And we'll see everybody next quarter or maybe sooner, depending on.
Bye, folks.